Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine this, a future where your ride-sharing app just seamlessly dispatches a self-driving car. Think about it, cost slashed, availability boosted, incredible efficiency.
Or flip that coin.
Right.
Imagine rival robo-taxi fleets, maybe from Tesla or Waymo, just eating into that dominance.
Yeah.
Suddenly, human drivers might seem obsolete, profits can plummet.
Exactly. What if these very technologies, autonomous vehicles and artificial intelligence, hold the power to redefine a massive $7 trillion global market, shaping not just one company's future, but maybe potentially your own investment portfolio?
That's the core question, isn't it? Will AVs and AI ultimately help or hurt Uber?
And that's our mission today. We want to unpack every layer of this for you. We're here to give you a shortcut to being really well informed on this pivotal topic.
So where do we start?
Okay, to really get to the heart of this, we'll look at the vision of Uber's leadership first. Then we'll dig into how its business model is evolving. It's quite dynamic. After that, the competitive landscape, its financial health, and finally, its current valuation. What's driving that number?
Makes sense. Leadership vision is definitely the place to begin.
All right, so let's talk about the minds steering this colossal ship.
Right. When we talk about Uber's strategy, you really have to start with Dara Khosrowshahi. He's been CEO since 2017, came over from Expedia.
Where he had a lot of success with global expansion and tech, right?
Exactly. And his pivot towards autonomous vehicles and AI at Uber, it isn't just a small adjustment. It's a fundamental strategic shift. He's been the driving force behind these key partnerships, like with Waymo and Pony.ai.
The goal being to integrate robo-taxis into their platform.
Precisely. They're aiming for an, frankly, incredible 80% long-term reduction in labor costs. But here's the really clever part. Uber isn't buying the robo-taxis themselves.
Ah, the asset-light approach.
That's the one. It's not just about dodging massive capital spending, though that's huge. It's strategic. It lets them be flexible, adapt, scale globally without that crushing financial weight that some rivals face, the ones trying to build it all in-house.
We saw that with Waymo in Atlanta recently, didn't we? Expanding rides there in 2025.
Yes, exactly. Testing how that AI integration works in the real world without disrupting the core business.
That asset-light strategy sounds incredibly smart for Uber. But is there a flip side? A risk they get too reliant on partners, or that the partners eventually try to cut them out? And how does the rest of the executive team fit into this big picture?
It's a fair question. And they try to mitigate that risk partly by partnering with multiple AV companies. They aren't putting all their eggs in one basket.
Spreading the bets.
Right. As for the team, it's clearly a group assembled for this specific future, AVs and AI. You've got Andrew McDonald, the president and COO. He's crucial for operations. Think AI-powered routing algorithms to optimize driver paths. That groundwork is vital for when AVs become more common.
Making the network smarter, essentially.
Exactly. Then there's Prashanth Mahendraraja, the CFO. He keeps the focus on financial discipline, especially with these big AV investments. He's even talked about how AI data platforms could open up totally new revenue streams, maybe selling enterprise AI tools, balancing growth and profit.
And navigating the regulations must be tricky.
Absolutely. That's where Jill Hazelbigger comes in, SVP of Marketing and Public Affairs. She uses her political savvy to handle the regulatory hurdles for AVs, lobbying for approvals. That's essential work. And importantly, Nikesh Arora joined the board in May 2025.
The AI and cybersecurity expert.
Yes, his expertise is directly influencing their self-driving tech strategy.
It definitely seems like a very deliberate, aligned team. But, in a company changing as fast as Uber, is there any hint of internal friction? Different ideas about how hard to push on AVs and AI? Is it still the founder's company in spirit, or has this new leadership really taken over?
Oh, this team is firmly in control. It's not founder-led anymore. Travis Kalanick was out in 2017. There's been some chatter about him maybe funding an AV deal peripherally, but he's not making decisions. Garrett Camp, the co-founder, has a very minimal role.
So Khosrowshahi is the key figure, often called a turnaround genius.
Right. He is. He gets credit for steering them to profitability after the IPO. His vision for these AV partnerships is clear. Now, executing it fully in this competitive space, that's the real test. And it's worth adding, their compensation, heavily tied to stock performance and gross bookings.
Aligning incentives with these long-term AI goals.
Precisely. Their mission is reimagine the way the world moves for the better, aiming for zero emissions by 2040. The vision includes AI handling pricing, routing, 24/7 AV service, and they stress integrity and safety in AV trials. Building trust in AI is paramount.
Okay, so with that leadership vision setting the course, let's pivot to the engine itself. Uber's business model. For years, it seemed simple, connect rider, connect driver, but AVs and AI seem to be transforming that into something much more complex, maybe much more valuable. How are you seeing that evolution?
It's a genuine transformation. Think of the Uber app becoming less of a simple marketplace and more of an AI brain. It's predicting needs, using machine learning constantly to optimize something like 10 million trips every single day.
Like the dynamic surge pricing?
Exactly. That's not just basic supply and demand anymore. It's complex AI analyzing patterns, adjusting fares almost like an advanced stock exchange, matching supply and demand super efficiently. It's about making the whole network way more intelligent, more predictive.
So what does that look like across their actual products? They're more than just rides now, right?
Oh, much more. The product suite is pretty diverse and still growing. Ride-sharing is still the core, naturally. UberX, Black, Comfort. And they've launched Route Share, too. That's their super affordable option on fixed routes.
How's that doing?
Pretty well in test. Cut fares by 20–30% in pilots, boosted trip volume about 10%. And the main rides business is strong. 170 million monthly active users, 2.7 billion trips in Q1 2025 alone. That's 25% year-over-year growth in mobility revenue.
And beyond rides, Eats, freight.
Right. Uber Eats food, groceries that's seen fantastic growth too. 15% year-over-year in delivery bookings, hit $18.5 billion in Q1. AI is everywhere there, from writing menu descriptions to giving merchants insights. Then there's Uber Freight, logistics, supply chain, using AI for route optimization, load matching. That brought in $1.5 billion in Q1 revenue.
Any other emerging areas?
Definitely. Uber for Business is growing, and Uber advertising is becoming significant. They rolled out ride offers globally in June 2025 that added something like a $200 million annualized revenue run rate. And the newest big thing is their expanded AI data platform.
Monetizing their trip data.
Exactly. Anonymized data used for training enterprise AI models, turning operational insight directly into revenue. It's quite something.
Those numbers are definitely solid. It really sounds like they're building out a broad ecosystem. But how much of that growth is really down to AVs and AI specifically versus just expanding the traditional stuff?
That's the crucial question. While all these parts contribute, the overarching strategy, and where a lot of the future growth is expected, is absolutely driven by integrating AI and AVs. Collectively, these products hit $42.8 billion in gross bookings in Q1 2025, up 14%. They have 8.5 million active drivers and couriers. But here's a key point. While Uber has that dominant 74% U.S. rideshare, in markets like Phoenix, where Waymo also operates, Waymo is already grabbing over 10%.
Showing the disruptive potential of AVs.
Precisely. So Uber's roadmap is laser-focused on this integration. Zero-emission platform by 2040, affordability, scalability. Expanding shared autonomous rides, they talked about that at their GeoJet 2025 event. They're leveraging data from 12 billion past trip to train AI.
For predictive analytics, autonomous trucking.
Yes. And future milestones include Level 4 AV trials in London with Wave later this year and broader robotaxi deployments.
So we're seeing the theory become practice. Have these recent launches actually moved the needle financially? What are the tangible impacts?
We are seeing real impacts. The 2025 launches really focused on affordability and AV/AI innovation. Route share, cut fares, and boosted volume, as I mentioned. Shared AV rides in Atlanta and Phoenix. They gave a 5% lift in bookings in underserved areas. People are trying it.
Channel partnerships.
Those May-June 2025 deals, Pony.ai, WeRide for 15 cities, Momenta, Wave in the UK, they've sped up testing and deployment. The NVIDIA collaboration from CES 2025, that's about faster AI simulations, maybe cutting development time in half. That helps margins.
And we saw that in the numbers.
We did. Q1 EBITDA earnings before interest, taxes, depreciation, amortization was up a massive 82% to $1.4 billion. And that Uber advertising expansion adds another $200 million run rate. New monetization is kicking in.
It sounds great, but all this innovation must cost a fortune. How are they funding this transformation? Anything unusual on the finance side?
They're sticking to pretty traditional methods. In May 2025, they did a $1 billion private placement of exchangeable senior notes. Standard stuff to fund operations, including AV investments, no crypto-backed treasuries or anything exotic.
Keeping it conservative on that front.
Right. It lets them focus on the AV and AI roadmap without extra financial volatility, which, indirectly, should help investors through more stable long-term growth. But what really sets their model apart is being this platform aggregator for AVs. Instead of needing $10 billion plus, like some rivals, to build their own fleets.
They partner up, like with Volkswagen.
Exactly. That 2025 VW-ID Buzz partnership is a perfect example. Deploying AVs through the Uber app. It lets them blend human drivers and robot services seamlessly. It positions them to grab a big slice of that robo-taxi market, which some project could grow at an incredible 90% compound annual rate through 2030.
That's a smart way to scale without breaking the bank. What about their track record? Especially with AVs, have they always had this partnership focus?
Well, Uber started in 2009, IPO'd in 2019, and hit that key profitability turnaround in 2023. The pivotal AV moment was actually in 2020. They sold their own self-driving unit to Aurora.
After that fatal accident, right?
Yeah. Yes. It was a major strategic shift towards this partnership model. Not a retreat, but a re-strategizing. Their overall revenue hit $37 billion in 2024, up 17% year over year. They still hold that 74% U.S. rideshare share. They've adapted well to AI trends like predictive analytics boosting efficiency by maybe 15%.
And their operational footprint.
Huge. Over 10,000 cities, 70 countries. But low vertical integration, they don't own the cars or make the AVs. Distribution is direct via the app with AI personalization. Revenue is variable, but the Uber One subscriptions add recurring income. Q1 2025 showed solid 16-20% year-over-year gross bookings growth, partly stabilized by these long-term AV contracts.
Okay, it sounds like they're strategically positioned, but this market is fierce. What really gives Uber its edge? What's its defensible moat?
Uber's moat is genuinely formidable. That 74% U.S. market share is huge. Regulatory hurdles for new AV entrants often favor incumbents like them. Then there are economies of scale. A bigger network means lower costs per ride. AI helps scale their data processing too, actually cut marketing spend 10% year over year.
But the core is the network effect, right?
Absolutely. That's the heart of it. Like a social network, more users attract more drivers, and eventually more AVs. It creates this positive feedback loop, a flywheel effect.
Yeah.
Each new user makes the service better for everyone else, makes it incredibly tough for newcomers. Their user base is growing 15% year over year, which helps accelerate AV adoption.
And that idea of being an AV aggregator, how does that really set them apart from, say, Tesla's approach?
That's what we call counter-positioning. Tesla wants to own the whole stack, make the car, run the service. Uber is positioning itself as the app store for all autonomous fleets. They aren't building the cars. They're the platform connecting you to any robotaxi.
More flexible.
Much more. It's hard for a vertically integrated player like Tesla to compete with that open platform approach. Plus, switching costs for users are real app familiarity, safe payments, habits. The brand is strong, allows some premium pricing. AI helps loyalty with personalization. They also have key resources, patents, and AI routing, crucial partnerships like with NVIDIA, which helps attract top AI talent. Their process power. AI matching algorithms are maybe 10 times faster now. Their AI platform predicts 10 times better. They timed their entry into ride-sharing perfectly, and their AV entry aligns with this 2025 commercialization wave.
They seem to move fast, too.
They do. Rapid AV launches, like with May Mobility, discourage competitors, the main threat. Maybe erosion from new entrants like Tesla Robotaxi, or if regulators ban AVs.
So pulling this together, what's the growth strategy and the ultimate prize here?
Strategy is clear. Penetrate markets with AVs, enhance products with AI. AVs cutting costs by 40% or more. That drastically boosts margins. Huge potential in new markets. Those 15 cities from the Weir ideal. Maybe M&A like the Pony.ai talks. And the prize. It's that staggering $7 trillion global mobility market. The AV slice alone could hit $1 trillion by 2030. Uber wants a 20% share of that via partnerships.
Main risks.
Competition Tesla, Waymo primarily, and potential AV safety incidents that could trigger backlash or tough regulations.
Okay, let's shift to the financials and valuation. How do the bigger economic trends affect Uber? Interest rates, inflation.
Macro factors definitely matter. Rising interest rates mean higher borrowing costs for AV investments. Uber has about $5 billion in debt, so interest payments go up. They also have a solid $7 billion cash cushion.
And trade tensions.
Things like U.S.-China friction could disrupt AV supply chains. Tariffs could raise costs, but again, the partnership strategy helps spread that risk. Inflation squeezes margins higher fuel, driver pay, but AI and AVs reducing labor dependence helps offset that, lessens the hit on demand.
And labor shortages.
Actually, things like the 20% shortage seen in delivery accelerate the push for AVs, makes AI essential to fill the gaps.
So, financially speaking, what does Uber look like right now? Is it still that company burning through cash?
Not at all. That's changed dramatically. Uber is profitable now, and AVs and AI are helping drive that. Q1 numbers showed revenue up 13.8% year over year to $11.53 billion. Gross bookings up 14% to $42.8 billion. That's not just growth, it's profitable growth.
A big turnaround for investors.
Huge, especially as AV trials add trips without adding proportional costs. Operating margin is 10.65%, net margin 27.07%. AI is clearly helping cut overhead, and free cash flow, the actual cash generated after expenses, jumped 33% to $1.5 billion.
That's serious fuel for expansion.
Exactly. Lets them fund AV and AI growth without constantly needing new debt or equity. They did 2.7 billion trips, up 15%, now have 156 million monthly users. The financial picture is pretty robust.
What's the general feeling among investors now? Excitement? Worry?
It's definitely mixed, but leaning positive. If you look at recent online chatter, maybe 60% of individual investor sentiment seems positive. People are excited about the Waymo deal, the AV partnerships.
And the negatives.
About 30% are worried about disruption, especially from pure play robotaxis like Tesla. The rest, maybe 10%, are kind of neutral, waiting for more data. The dominant story is optimism about AI helping Uber scale, but with that undercurrent of concern about competition.
Okay, bringing it all together, valuation. Uber stocks had a big run. What's baked into the current price? Does it reflect these huge ambitions?
Well, as of Q3 2025, the stock's around $96. That's after a really strong rally, over 60% year to date, hitting record highs. A lot of that is clearly fueled by enthusiasm for these AV partnerships and AI integrations accelerating.
Pushing the market cap over $200 billion.
Right, and that price tag implies some big expectations. It assumes AVs will fundamentally change the cost structure, potentially wiping out 80% of ride costs tied to human drivers. But it also reflects risks, like Tesla launching robotaxis and maybe fragmenting the market.
So why is getting the valuation right so critical for individual investors here? It's more than just a number.
Absolutely. Valuation is your guide. It helps you figure out if Uber's AV and AI story justifies the current price. Is it a bargain, set to capture a huge chunk of that potential $1 trillion U.S. AV market by 2030? Or is it overhyped, vulnerable, if competitors bypass its network?
It tells you if AVs will unlock massive value or if the stock's already priced for perfection.
Exactly. Does the asset-light platform scale exponentially? Or could commoditization lead to corrections? It's about weighing future potential against today's price.
So how do we actually try to value a company like Uber with all these massive changes from AVs and AI? What tools do we use?
It really requires looking at it from multiple angles. Intrinsic methods, like a discounted cash flow or DCF, are good here. You project out free cash flows, maybe 10 years, and build in scenarios for AV adoption.
What might that look like?
Okay, so a base case, maybe assuming 20% of rides are AV by 2030, that could suggest a value around $120, $140 per share. If you're more optimistic, say 50% AVs, maybe it pushes over $200, but a pessimistic view, where AI disruption costs them 30% market share, that could drop it down to $60.
So a wide range depending on assumptions. What about comparing it to others?
Right, relative valuation. Uber trades at about 4.5 times forward sales, maybe 39 times enterprise value to EBITDA. That's definitely premium compared to, say, Lyft.
But potentially justified if the AV growth pans out.
That's the bull argument. If those partnerships deliver explosive, consistent growth, maybe 15-20% compound annual growth in bookings, then the premium makes sense. You can also do a sum of parts, value mobility, delivery, and that emerging AI data platform separately. That might total over $220 billion in enterprise value. These different methods help paint a fuller picture.
This really leads us to the core debate, the competing arguments. Let's lay out the bear case first. Why might AVs and AI ultimately hurt Uber, maybe even destroy the model?
The bear case is essentially that Uber's model is fundamentally fragile in the face of this tech. AVs and AI could make their human driver network obsolete, their platform irrelevant. Think irreversible market share loss, squeezed margins, decline.
Who's making this argument?
You hear warnings from firms like Goldman Sachs, Barclays. They suggest pure-play AV leaders, particularly Tesla and Waymo, will just bypass Uber completely. Tesla's robotaxi, aiming for unsupervised full self-driving later this year. If they can offer rides at, say, 20-30 cents a mile versus Uber's $1 or $2.
By cutting out the labor cost entirely.
Exactly. Tesla could capture 100% of the economics, no need for Uber's platform. Some analysts project Uber's U.S. share could fall from 74%, potentially below 40% by 2030, if that happens.
And regulations.
That adds another layer of risk. AV safety incidents could trigger bans or rules that favor companies owning their fleets. Labor reclassification lawsuits are still a threat too, potentially hitting flexibility and costs. Macro issues like inflation add pressure, and that $5 billion debt could become a problem if AV spending ramps up without quick returns.
Retail sentiment sometimes focuses on the human element too, right?
Yes, you see that online. The idea that Uber's value is just the human connection, which becomes worthless against an integrated AV stack.
That's a stark picture. But if Tesla could offer rides that cheaply, how could Uber even compete? Does the network advantage matter if the cost gap is that huge, or is there a strong counter-argument?
It's the critical point. The bull case offers a powerful counter-narrative. It argues AVs and AI will profoundly help Uber, transforming it into the dominant app store of mobility. The idea is Uber uses its unmatched network to aggregate demand/costs and expand its market to potentially $7–10 trillion globally.
All through integrating robotaxis without owning them.
Precisely. Optimists at places like Morgan Stanley, Wedbush, they emphasize the partnerships. Waymo, NVIDIA, Pony.ai. That's asset-light scaling. AVs could cut ride costs by 40–80%, pushing EBITDA margins towards 30–40%, unlocking that $1 trillion U.S. opportunity with 247 utilization.
And the AI side.
AI enhancements are key too. Monetizing that data from 12 billion trips for model training, using routing algorithms to boost efficiency, 15%. This positions Uber as an AI leader in mobility.
And the network effect makes bypassing them hard.
That's the argument. With 170 million users, it's almost impossible to ignore. Even rivals like Tesla might find it more efficient to partner with Uber for demand density rather than build their own ride-hailing network from scratch.
Retail sentiment often echoes that.
Yeah, you see the App Store of autonomy idea? Bulls see AVs and AI as catalysts, driving 25% plus compound annual growth rates.
Okay, we have these two strong opposing views. For you, the individual investor trying to make sense of this, what's the most likely outcome? Which thesis seems more probable?
For me, the bull case feels more probable right now. Uber's strategic choice to be an AV aggregator, look at the 2025 deals adding 15+ cities, the new AI data ventures it fundamentally hedges against disruption risk while capturing a lot of the upside.
And the market seems to agree.
The 60% year-to-date stock gain, the generally positive analyst tilt as AV commercialization progresses, it suggests the market is leaning this way too. Uber's playing a different, arguably more flexible game than the pure-play manufacturers.
So bringing it back to valuation for the individual investor, what's the bottom line at this point? What does this all mean for the stock price?
Based on that bull thesis, looking at Q1's 15% bookings growth, the potential 20–30% margin expansion from AV partnerships, and those DCF estimates pointing to 120–140 intrinsic value, Uber trading around $96 suggests a meaningful discount, maybe 20–30%.
Offering an entry point.
It looks like a potentially compelling entry point for investors who believe AVs and AI will ultimately boost, not break, the model. That valuation gap offers a margin of safety against short-term bumps, while positioning for potentially significant gains if integrations like the May mobility launch in Arlington scale up successfully by year-end.
So after digging through all of this, we come back to that big question. Will autonomous vehicles and AI ultimately help or hurt Uber's business model? It's complex, definitely lots of moving parts, but the weight of the evidence seems to point pretty clearly in one direction.
It really does. The verdict leans strongly towards AVs and AI will overwhelmingly help Uber's business model in the long run.
They're shifting away from being just a labor-heavy platform dealing with driver churn and costs.
And becoming something much more powerful. A scalable, tech-driven mobility ecosystem. Less like a taxi firm, more like the operating system for movement, fueled by AI and AVs.
And that's grounded in that strategic choice, the asset-light aggregator model.
Exactly. Using partnerships means they integrate AVs and AI without the massive capital costs that burden others. Look at the Waymo expansion in Atlanta. Seamless integration via the Uber app, boosting shares, showing AVs can increase availability without needing more human drivers.
Or the Volkswagen deal.
Right, the July 2025 announcement to deploy autonomous ID buzz vans globally using mobilized tech.
Yeah.
On the AI side, they're monetizing that huge data trove, 71 million miles worth of driving insights, using tools like predictive routing, dynamic pricing. That's already boosted efficiency by 15%.
And the cost savings projection.
Projected to cut per rod cost by 40–80% as AVs replace labor. That could push EBITDA margins from around 10% now towards 30–40% by 2030. It's potentially transformative.
But surely it's not all smooth sailing. There must be short-term bumps in the road, things that could slow this down.
Oh, absolutely. Short-term challenges are real. What if partners like Waymo decide to go direct-to-consumer more aggressively? That could chip away at Uber's role. Regulatory delays are always possible, like the UK pushing AV deployment to 2027. That slows the global rollout.
But the network effect is the defense.
It's a huge defense. 170 million monthly users, 2.7 billion trips a quarter. AV providers need that scale, that demand density that Uber offers. It's why AVs and AI ultimately seem to mitigate Uber's biggest historical weaknesses. Driver churn, cost surges, while opening up new revenue streams like AI data services and freight automation.
And the potential impact on bookings.
If AV adoption hits, say, 20% of rides by 2030, some estimates suggest gross bookings could surge 25% annually. Now, for an asymmetric insight, something perhaps underappreciated, that data moat from 12 billion trips. It makes Uber an AI powerhouse in mobility. They're building this quiet revenue stream from data annotation, model training that might not be fully baked into the stock price yet.
So what should you watch for?
Keep an eye on AV pilot metrics. Things like Waymo's uptime in Atlanta, they aim for 99% reliability. The data isn't always public, but leaks or announcements can give early clues about faster than expected margin improvements.
And thinking about risk.
Understand that the aggregator model is a de-risking strategy. Diverse partners, Waymo, Pony.ai, WeRide, VW spreads the tech bets. If one falters, they can pivot. It's unlike competitors betting on a single in-house technology.
Known unknown.
Regulatory approvals, delays, partner reliance, and always the wild card of a major safety incident.
And the unknown unknowns.
Could be anything. Emergent AI breakthroughs like quantum navigation, geopolitical shifts hitting supply chains for global partners. Hard to predict.
Any final clues?
Listen to leadership. When Dara Khosrowshahi says they get zero credit for AV leadership, maybe that hints at undervaluation. Watch individual investor sentiment shifts online too. Sometimes they catch trends early. Ultimately, this whole situation just shows how profoundly one technological shift can ripple through an entire industry, changing how we literally move around. Keep exploring, keep questioning, and keep learning.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.